This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll take a look at how one company is looking to fix your terrible board meetings.
Plus, we'll discuss why many swing state voters say they're worried about violence surrounding the U.S. presidential election.
But first, we dive into big tech and Nvidia. This week, the chip maker gave a bullish forecast for second quarter revenue.
Nvidia also reported that its sales in the first quarter more than tripled to $26 billion, and this shows that spending on artificial intelligence computing remains strong.
For more, we were joined by Kunjan Sobhani, Bloomberg Intelligence Senior Semiconductor Analyst. We first asked for his takeaways from Nvidia's results.
Demand on most of their products keep running ahead of supply. We don't see any slowing down in terms of purchasing from their customers. In fact, beyond their largest cloud customer, enterprise and consumer internet companies are coming in strong. So we don't see any sort of big risk that says they cannot continue.
So Kunjan, I was telling Alex, when we get smart people on like yourself, I like to ask the question about competition. I'm kind of surprised that, Nvidia has this competitive leadership position relative to everybody else. How proprietary is their chip design versus, the AMDs of the world, even a Cisco? What is the competitive landscape?
Yeah, look, they were, I would say, almost 2 to even arguably 3 years ahead of everyone. And it's not easy in the chip landscape to catch up when someone has that kind of a lead. They have actually aggressively gone out and out-innovate their peers. Before they were on a 18 to 24-month product cycle. Now they are on a 12-month product cycle. So they just keep staying ahead of their competition. Their competition is trying to catch up. AMD has made significant progress and now is another second viable alternative in the market. Hence, you see that in their significant growth as well. But we don't think at this point there is anyone else who can rival the total system TCO and performance that they have.
I was mentioning earlier that Nvidia gets about 40% of its revenue from the big four players, Microsoft, Meta, Alphabet, and Amazon. What kind of risk is that, if any?
There have been concerns around it. So there's 2 good data points that came out of this print. One, that concentration did reduce for the very first time. And what we liked, it was not reduced because the cloud guys slowed their purchasing. In fact, those top 4 guys are expected to increase their CapEx spend by 45% this year. Wow. And they're all lined up to purchase its newest Blackwell products. But what was good was that the share was taken by strong enterprise demand, which we really like because that is much more diversified and sticky.
Kunjan, let's say I'm at Amazon and I buy one of Nvidia's chips. When do I have to replace it?
Good question.
There's 2 answers to it. If we were in a normal sector semiconductor cycle, like you are in smartphones or PCs, the refresh time would be longer. So I would say ideally 3 to 5 years. But what's going on right now is all of these customers are just racing against each other. So they cannot afford to stop. So as soon as a newer, better chip is available that they can change, they are going to change.
What would stop all this? We know that AI is going to grow. We know that there will be demand for chips. We know all that. That's a structural shift within the economy. But what makes it cyclical?
I think the first point of cyclicality would be when the demand momentum stops, which we haven't seen no signs of. Look, the supply keeps on coming up. So at some point, demand is going to be meeting supply. And after that, if we see any kind of weakness in demand, look, if the largest cloud providers don't see return on their investment, don't see monetization benefit, don't see their earnings and revenue grow from these investments, that's when we can start worrying about sort of a cyclical downturn.
All right. So how else in your universe of semiconductors, how else do you play this trend?
Look, Nvidia still remains sort of the best pure play AI play in semiconductors. So I don't know why you would want to look elsewhere. But if you were forced to, we also like players like Broadcom and Marvell when it comes to AI networking, when it comes to the ASIC chips, which Nvidia's largest customers are designing themselves. So these are the two areas where we see significant growth coming in over the next 2 years.
Our thanks to Kunjan Sobhani, Bloomberg Intelligence Senior Semiconductor Analyst.
We move now to the home improvement retailer Lowe's. Lowe's said the comparable sales fell 4.1% in the first quarter, though they were better than analysts projected.
This all comes as uncertainty around interest rates and inflation continue to weigh on home improvement demand.
For more on all of this, we are joined by Drew Redding, Bloomberg Intelligence U.S. Homebuilding Analyst.
We first asked Drew for his key takeaways on Lowe's most recent report.
Quarter was a little bit of a tug of war between sales and margins. Part of that sales performance was due to the fact that there was a more promotional environment out there. If you think back to when Home Depot reported last week, they cited a late start to spring as something that muted sales. Lowe's actually said spring got off to a good start, and that has to do with them being more aggressive on promotions as part of their Spring Fest. And I think that really speaks to, what we're seeing really across the retail landscape with the consumer, and that's that they're looking for value wherever they could get it. Now, they did reaffirm their full-year operating margin guidance, but that's going to require the company to execute on some internal initiatives in the back half of the year. Lowe's has made good progress in improving their margin profile, and them narrowing the gap with Home Depot has really been a key that investors have kind of, grasped onto. So the fact that they're taking a little bit of a step back here may be making some a little bit uneasy.
How much would the stock have to re-rate for investors and analysts to say, okay, fine, the margins are suffering, but at least the volume and the sales are there?
Yeah, well, the stock is still trading above, the 10-year average, even if you go back to prior to the pandemic. So from a pure valuation perspective, it's still a little bit elevated. The move they've made on margins and narrowing the gap with Home Depot has been impressive over the last couple of years. So I think, the bulls would argue that this is kind of a one-off. And as we get to the back half of the year, margins start to improve as they implement some of their PPI initiatives. And in terms of sales, we're not expecting a huge rebound in sales this year. In the second half, comps will definitely get easier, but even Lowe's has stated that comps may turn positive, but that's not a reflection of an improved demand environment. It's strictly a reflection of easier comps. So we think as we get into 2025, that's when we would expect the market to see more of a turn as we get more of a rebound in existing home sales.
How about lumber? That's something they buy a lot of. How's the cost of lumber these days? How's that impacting their margins?
Yeah, lumber is about 10% of sales for both Home Depot and Lowe's. Lumber was really more of a story last year. It was extremely volatile, so you saw the impact on their top line there. Not so much of a story this year. I think commodity, particularly lumber, are going to have less of an impact in the near term.
So you feel like we're not going to really see a benefit until 2025? I mean, some analysts are looking for the back half of this year, maybe some improvement, but for you, it's really like a year out kind of thing?
Well, I think as we get to the end of this year, I think you'll start to see a little bit of a turn. And a lot of that is predicated upon with what happens in the housing market. Obviously, people are looking for the Fed to cut rates at some point this year. Obviously, not as much as we had hoped for previously. But we think that, when you look at existing home sales, we're, at the lowest levels in, more than 2 decades. So there's not a whole lot lower we can go absent, a broader economic decline where you start to see a lot of job loss. So we think that, if rates come in a little bit, you could kind of start to build a little momentum ending this year, carrying into next year. When we think, bigger picture about the home improvement market, there's some solid tailwinds out there. You have homeowners who are sitting on record amount of home equity. When you think about, the rise in home prices we've seen over the last several years, you've got an aging housing stock. And I think the fact that mobility has been so low is going to continue to encourage people to invest in their house. And I think what kind of triggers that is rates coming back in a little bit so you can start to tap that equity.
Drew, how many stores does Lowe's have? And are they adding stores? Are they paring back stores? Kind of where are they with their store count these days?
Yeah, so they're under 2,000. It's an interesting dynamic. So their competitor Home Depot is actually embarking on their first store expansion in a long time. Lowe's, on the other hand, has cut back. They got out of their Canadian business, which reduced their store count. But what they're doing from a store perspective is really introducing new formats. So they're starting to go after the rural customer. Their stores tend to be located in more rural locations compared to Home Depot, which are more densely populated locations, and they found success with that. So they're starting to compete more with the Tractor Supplies of the world. They're also introducing Lowe's outlets. So if you think of, appliances that might have dings and scratches, you could go there and get heavily discounted items, and that's another way they're looking to kind of drive traffic through the Lowe's brand.
Okay, now you're speaking my language. You put outlet there, and I'm like, boom, we will go find things that are cool.
I don't do outlets either.
You do? Oh, I know you don't do outlets.
No.
That's my thing.
Yeah.
It's just my thing.
Okay.
Even if I had $1 billion, I wouldn't pay full price. Part of the hunt.
Okay.
Yeah.
All right.
Anywho, so Drew, based on all this, if I wanted to play this housing market right now, what is the best play? And I say that because it's not like the housing market. That the demand isn't there, the supply might not be there, the costs are a little too high, mortgage rates are too high, but eventually it'll normalize. What's the best way to capitalize?
We think right now, kind of sitting at the top of the broader housing ecosystem is the home builders. We think, from a supply perspective, they're in a good position. Their ability to buy down mortgage rates and make payments more palatable to the consumers is something that differentiates them versus the resale market. They're going to grow community counts in the coming years. So we really think that they're still in a good position from a competitive perspective. And when you look at, within the home building space, you have the large, well-capitalized, publicly traded home builders who have access to land, access to labor, and you compare that versus the smaller private peers. And you have to remember, home building is a very fragmented industry, particularly outside some of the largest markets. But those smaller private peers tend to rely on regional banks for growth capital. And with, a slowing economy and more concern there, you're starting to see a pullback in lending. So we think it's a good opportunity for those larger builders to continue to take share.
Our thanks to Drew Redding, Bloomberg Intelligence U.S. Homebuilding Analyst.
All right, coming up, we're going to stay on retail and break down Target's quarterly results.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
We look now at the retailer Target. This week, the company reported first quarter earnings that missed analysts' expectations, and its sales fell about 3% year over year.
Target also said it remains cautious on discretionary spending over the coming months, despite having optimism for later this year. For more, we were joined by Jennifer Bartashus, Bloomberg Intelligence Senior Analyst, Retail Staples and Packaged Food.
We first asked Jen for her reaction to this week's report.
Target missed on profit, but they are very optimistic about second quarter and for the rest of the year. And so I think there's a little bit of reticence about how realistic that is. When it comes to second quarter, in terms of same-store sales, Target says that they're going to return to profit, like they're going to return to growth in second quarter. It's feasible, but remember, last year, second quarter is when they had the blowback from all of the boycotts. So they have a really easy comparison when you talk about a year over year. So that return to growth, yes, but there's a caveat around it. That means to me that the second half is going to be really important if they're going to reach those goals that they put out to.
Is the Target shopper the same, similar, no relation to the Walmart shopper?
Well, historically speaking, the Target shopper has been a slightly higher income household. They tend to be a little bit more fashion forward, fashion focused type individuals. So there's been overlap, but Walmart has slowly been encroaching on what has been Target's kind of main audience. And Target has seen that their customers are under a lot of pressure because they're sort of middle income households. There's been a lot of inflationary pressure, a lot of cutbacks in discretionary spending. So there's been kind of pressure from both sides. And so Walmart says they're going to up their private label game, especially in apparel. That could be a threat to Target, but it is one of Target's core strengths. So if they can get people to come back and start engaging again, that's really what historically has helped Target drive their success.
So reaffirming their guidance for the full year, I mean, like you mentioned, that means that they're going to have to really deliver in the back half. What are the levers they can pull to do that?
So from a profit perspective, they have a lot of things that they've been doing in terms of cost control, in terms of streamlining their supply chain. Their inventory was down another 7% this quarter. Those are all great things because it helps make them more efficient and cost effective. So from a margin perspective, there's still some runway to continue to expand margins. The real question is, are they going to be able to drive sales growth? What's concerning is that the in-store sales for same-store sales are still significantly lower. And part of the idea behind the discretionary categories is that people come into stores and they browse and they find an outfit or they find an accessory. And it's great that digital sales are reaccelerating, but if people aren't in the store, that's a hard thing for Target to deal with.
Hey, Jen, when I think back to the Walmart releases that I've really paid attention to, I always see double-digit, maybe 20% e-commerce sales growth. How does Target do there?
Well, Target actually does pretty well in terms of digital sales growth, but there's a very different strategy. Walmart is pursuing a strategy of as many possible items as possible on the Walmart.com. They do a lot of third-party sales. When it comes to Target, their broader assortment is much more curated. And so they are very thoughtful about which vendors they bring onto the Target.com to enhance the offering that Target has. So there are different approaches to e-commerce. Both are seeing some success, but you can't really compare them strictly side by side.
What other company, what did you make of then TJX, for example? Because in some ways they can be immune from the slowdown, right? Because everyone, me included, will go shop there. Are we seeing that reflected in the numbers?
I mean, I think the strong results from TJX just underscore that people still like the treasure hunt, but people are seeking value. And one of the things that Target talked about is that they need to reinforce that value proposition. That's part of why they've rejiggered their entire Target loyalty program with Target Circle. TJX, everybody knows you can go and you have the potential to find something that is an amazing deal. And that's enough to draw people into stores.
Really?
Target has gotten a little bit away from that. Yeah.
Yeah. See, Paul doesn't. So Paul's never been in a TJX, so I don't think he truly understands the beauty of this.
I went to my first Walmart last weekend.
You
so
did,
yes.
So that's like a semi-gold star. So they have not only just discounted stuff, but they have the runway. And that's the jam. That is designer stuff on some serious sale, and you can get that on clearance. And you're looking at like a 90% off a designer kind of situation.
Do you know beforehand whether it's going to be there?
No, that's the fun. Then you add the treasure hunt, and you don't know the beauty that will be unveiled as you go in. Am I selling this appropriately, Jen?
Absolutely. I mean, that is some of the appeal. You never know what you're going to find, and so you go as often as you can because there's a chance you'll find that amazing deal.
What's the promotional environment out there, Jen? Are the Walmarts, the TJXs, the Targets, are they putting out a lot of promotions to get people in the store or to click that button?
The promotional environment has been escalating. And so you hear Walmart talk about rollbacks. That's basically putting things on sale or discounts. Target talked about cutting prices by the end of the summer up to 5,000 items, all for essentials. So the idea is to try to advertise that there's value proposition there and enforce that they're looking out for the customer, trying to get people to engage in coming back and perhaps buying a little bit more. And let's be honest, it doesn't hurt from a public relations perspective when you have the White House talking about retailers not being responsible enough and rolling back costs on essentials. So there's certainly a little bit of a play there to help appease some of that political pressure as well.
But that doesn't make me want to buy the stock, though.
No, but it does help ultimately from a consumer perspective. If you think that it's a better value to shop there or that you're getting more for your money, you're more inclined to shop there, and that ultimately leads to your traffic and your sales, and that is what is appealing to investors.
What are the dollar stores seeing these days? Are they seeing a pickup in traffic, maybe the people trading down from a Walmart or a Target?
There's been some trade down into the dollar stores, and we tend to see that every time we go through sort of an economic depression. One of the challenges for the dollar stores is that people are coming in, but they've abandoned the discretionary spending, even though at a dollar store, the discretionary spending is not that expensive. So their consumables mix, for example, at Dollar General is close to 80% of their sales are what would be considered consumable items. That is good in terms of people coming into the store, but it's not great for the long-term mix for the company because those are very low margin sales. They're high frequency, but people have been really watching those, watching their wallets. And so the basket sizes are a little smaller. The mix is more consumable. So we'll be watching for any signs that they're getting some higher income households coming in to spend on those more discretionary items, or that their core consumers are loosening spending a little bit. But
So,
honestly,
yeah.
this quarter it's probably not going to be, panning out.
No, definitely not. Target falling the most, I should say, going back to Target, the most since November of 2022. Does that feel extreme to you, considering that the actual numbers weren't like terrible?
I think you shouldn't diss Target for being Target, I guess is my response to that.
Ooh, I like
and what I mean what I mean by that is, Target has always been about the fashion, it's been about the discretionary categories, it's been about home decor, it's been about things, of that nature. They've never tried to be, heavy on the essentials category. And so when you've got consumer weakness and you've got people who aren't spending in those categories, it's hard to beat up Target for being true to what their values are. And so what I would say is, if we see some improvement in the discretionary spending, Target will start to take off again. Their sales will accelerate, people will be coming back. It seems more of a waiting game for when the consumer is ready for that at this point.
Our thanks to Jen Bartashus, Bloomberg Intelligence Senior Analyst for Retail Staples and Packaged Food.
On Bloomberg Intelligence Radio, we bring you all the top analysts providing in-depth research and data on 2,000 companies and 130 industries.
We also have something here at Bloomberg called Bloomberg New Energy Finance, and the idea behind it is to provide data on commodities, power, transport, industries, buildings, and agriculture, and also new technology.
This week, we also looked at a BNEF report that said governments and companies need to spend an extra $34 trillion on the clean energy transition between now and 2050 to reach net zero emissions.
For more, we're joined by Eamon Farhat, Bloomberg European Power and Renewables reporter.
We first asked him for more context on the BNEF report.
The report outlines two scenarios. One of them is exactly that, trying to get to net zero by 2050. So it is possible. It will cost something like $215 trillion between now and 2050, and 20% more than the actual kind of base case, which is if we just go along with all the different technologies that actually make economical sense. So the net zero scenario is about governments putting in policy and putting in drivers to make it happen faster.
Are the big, players globally, I'm thinking just the West broadly defined, China, do we have global buy-in to any of this right now, or is it just piecemeal?
That's a good question. I think one of the things that the report does is look till 2050, but as well as that, they also look for the next 5-10 years, and they show that the investment level that's being planned for the next, even just till 2030, isn't really there to keep on track to be reaching net zero. Isn't even there to be reaching any kind of these scenarios. So I'd say what the report really does say is that it is possible. We have to really start moving immediately, and that most players aren't moving fast enough. It's all a bit too slow.
Say that number again, about how many trillions of dollars more?
So it's $215 trillion for net zero. So that's about $34 trillion more than the base case.
Oh my gosh. Okay, is that all going to come from governments? At the end of the day, whether it's through taxes, etc.?
So that's going to be coming from government, from private investment. This covers everything. This covers everything from grid to EVs to, how you're going to be getting your solar panels on your houses, getting wind farms in the sea. It really covers everything. But it just shows that when you take a holistic view, the cost is very high. When you break it down by year, it might be, a few trillion per year, but over a 26-year period, that is a lot of money for the world to bear.
So, Eamon, talk to us about the next 10 years. What are some of the critical milestones that need to be met here? It feels like it's more than just everybody's going to have an electric vehicle.
Yeah, so when I was reading through this beautiful 250-page report, I think one thing that really stuck out to me at first is the report says that right now we start the 10-year countdown. In 10 years' time, there will be one ICE vehicle sold. It'll be all electric vehicles being sold. They want to triple renewables in that period as well to be on track for net zero, and then triple them again in the next 20 years. So it really is kind of everything is doubling down. They have this whole section about sustainable aviation fuel, trying to decarbonize aviation. I think they said that something like the crops you have to grow to get this biomass, to get this sustainable aviation fuel will take up as much space as the whole European Union. So some of these numbers are just really, really huge, but are needed in the next 10, 15 years.
And that's so important because we also need the stuff for food and things. So there's also that poses a lot of issues. I'm also curious as to the divide between developed and emerging markets when it comes to energy, because Europe and the US, we may have the money to tax and then maybe have the money to put forth, but India sure doesn't. Africa sure doesn't. Parts of Southeast Asia sure don't. How does the report address that lack of financing?
Yeah, it's interesting. I think on both hands, on some ways, when it comes to for example, grid is a huge thing. Actually the second biggest cost to come into this 215 trillion. And actually in some of the developing nations, as you said, India, for example, because the grid is actually newer there, it's easier to upgrade it and to kind of build it out. When you're talking about the British grid or the American grid, these ones are much older and harder to move forward. But then when it comes to things like renewables, we still see lots of coal, lots of gas, lots of fossil fuels being used in Southeast Asia into the 2030s, just because they need that supply. Demand is growing, air conditioning demand is growing, a growing middle class, which means that they just need to keep up, and they can't be going on to renewables as quickly as Europe can, for example.
Our thanks to Eamon Farhat, Bloomberg European Power and Renewables reporter.
Coming up on the program, we're going to take a look at how one company is looking to fix your terrible board meetings.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
We move now to politics. Half of swing state voters say they're worried about violence surrounding the U.S. presidential election. Now, that's according to the May Bloomberg News Morning Consult poll.
Many swing state voters also said they're worried that the growing presence of artificial intelligence could one day diminish privacy and hurt job prospects.
For more, we were joined by Jodi Schneider, political news director for Bloomberg TV and Radio. We first asked Jodi about violence being that big concern in the latest poll.
We've been doing this poll now since last fall, as you know, Paul, and we've been asking about the candidates themselves, and we continue to ask about that. But we wanted to ask on some issues as well, and this seemed to be one that's percolating out there quite a bit, that we hear a lot from. And so we went and asked the voters themselves, asked them, in these swing states, in these 7 swing states. And as you noted, about half say they are concerned about that, and it seems to be pretty evenly split between Republicans and Democrats in terms of that concern. So that's real, and that could affect them in terms of how they vote, perhaps whether they vote, because both parties really need big turnout. It's going to be, as everyone expects, a close election, close in terms of the popular vote, and of course that affects the Electoral College, which is where it comes down to where the rubber meets the road, if you will.
Jodi, does the fear sway how people are going to vote?
Well, I think it more could affect whether they vote, Alex. I really think that's part of it. If you fear that, perhaps there's going to be violence surrounding this, or there's this kind of fear about things, maybe you say, and we've seen a lot of polling around the fact that there isn't a lot of excitement around either candidate. We had at one point polls showing that they wish there were someone other than Biden or Trump. But this is who we have. This is who's going to be on the ballots. And so I think it's more going to be a turnout issue. We'll see. Now, of course, we do this polling and we all talk about polls a great deal in an election year like this. But it's still about 5.5 months out before the election. And a lot of people don't make up their minds fully until after Labor Day. So this is still, this is an issue that could affect voting, but we still have plenty of time before people actually start voting.
So, Jodi, aside from these issues, what are kind of the key issues that our polling has kind of illuminated are kind of going to be the key issues for these candidates through the election?
Yeah, so the race is narrowing according to, again, these are 7 swing states where we think, a lot of the election will be determined. And we found that 6 in 10 of the voters worry about misinformation, not only violence, but misinformation. 46% had concerns about perhaps foreign interference in the election. So that's an interesting take. We've seen former President Trump's swing state lead dipping slightly. He is still ahead in many of these swing states, according to our poll, but it has dipped slightly since the last time we polled about a month ago. So that could be viewed as a little bit of encouraging news for those who support Biden, but those who support Trump say, well, he's still ahead there. So we have that. We also have that Biden gaining ground from April in each of the competitive Sun Belt states. So that's an interesting factor that he's gaining there. The states where he needs to win, he absolutely must win what we're calling those blue wall states of Wisconsin, Pennsylvania, Michigan, which he won last time, which Hillary Clinton famously did not win in her race against Donald Trump. We're finding that he is doing a little bit better there. They're separated by no more than 2 percentage points in those blue wall states. So very close there.
Jodi, when you talked about misinformation, do we have an idea of where voters are going to get their information if they're worried about misinformation?
Well, that's a really good question, Alex. And so many of them talk about misinformation, but then they go to places where they are, where there's potentially misinformation. And a lot of voters are getting their news from a lot of places that we don't necessarily consider traditional news outlets. So it's an interesting question. We did ask about TikTok. That's been a big issue. The U.S. government has, under legislation that was passed for emergency funding for Ukraine and other places in the world, it was in there a ban on TikTok if the Chinese parent, ByteDance, does not sell it. We asked these swing state voters whether they thought it was a good idea to ban TikTok, and almost half said they thought it was. So another interesting wrinkle there in terms of information.
All right, thanks to Jodi Schneider, political news director for Bloomberg TV and Radio.
We now move to the cloud space. Zeck, a cloud-based software company, is now trying to fix any potential dread you may have for an upcoming board meeting.
The company distills hundreds of pages of corporate documents into interactive websites for boards to expedite meetings, and even has an AI product. And recently, Zeck announced it closed a $7.5 million investment led by Salesforce Ventures.
For more on all of this, we were joined by Zeck co-founder Edward Norton. We first asked him more about what Zeck is trying to do.
We're trying to make the experience between management of organizations, and I say that meaning corporations or nonprofits, because obviously we've got a couple million nonprofit organizations in this country that have governance and boards and stuff like that. We're trying to take what we feel is an increasingly toxic dynamic and reform it into being what it's supposed to be, which is a relationship that propels an organization, supports, brings additional leverage, positivity to an organization. And we, I've definitely had some people say to me, like, you have an interesting day job. Why would you get involved in a...
And your day job, just for folks that on the radio, Edward Norton, actors, been in a bunch of movies and all that kind of stuff.
Yeah. And I will admit that, on the surface, like a software platform for board governance features seems pretty esoteric, but it grew out of my own experiences over the last 30 years, not dissimilar to yours, from serving on the board of arts organizations, serving on conservation organization boards, and then as I built my own companies, and I've built a few software companies that we had our own boards, people like Fred Wilson from Union Square, or Axel or Greylock, or these firms. We were on the management side, and we were experiencing what it meant to have a board. And then when I sold one of my companies and I joined the board of GoFundMe, the company that acquired us, cool. I started sitting on corporate boards, and my partners and I really started feeling that there was this elephant in the room, which is that companies go through 4 to 8 times a year. They go pencils down to get ready for this thing that essentially to them feels like a hall monitoring moment. And board members, on the other hand, when I was a board member, 36 hours before the meeting, you get a 90-page PDF, and you're supposed to read it in the airport terminal, and then you go to the meeting and get it read back to you. You know what I mean? Like there was just, and
so you're looking to make it a more interactive, visual, engaging experience. I
think we say two things. One is quantitatively, board meetings are an enormous waste of time for everybody, and that has to do with the amount of redundant time waste on setting these meetings up and the presentation materials, and that can be crushed down by having cloud-based AI-powered tools that make it like 1/10 the time for a company. On Zeck, a company can set up for a board meeting in 1/10 the time that they were using to prep before it. Board members should get to read something that's, you wouldn't read the New York Times or Bloomberg on a PDF. You read it in a mobile friendly scroll, right? That we expect that now. And so everything about the user interface should be easier for both sides of the table. But also think about this. Think about how much time, how many professional, talented people whose time is valuable sit there in board meetings approving minutes approvals, approving stock option packages, things that they ought to be able to do from the airport lounge in advance. So we built governance function that can be interactive and mobile and all of it.
So your customer is the board.
The customer is the company and the board. You know, but both sides, management and board members, suffer in different ways, and we've tried to reform it. But when you crush the redundant inefficiency of time waste, you improve the quality of the meeting too, because a board meeting should be a forward-looking experience, not a, you don't want to spend hours looking backward. Everybody can ingest the looking backward part before the meeting. You want the meeting to be propulsive and additive to where the company or the organization is trying to go. And the best thing about what people are saying to us is not just, oh, we really love the user interface, it's much easier, it's easier to read. We love that they're saying to us, this has radically improved the quality and the value of the meeting itself and what we're getting out of our board.
So you guys just raised about $7.5 million Series A led by Salesforce Ventures, including some other guys as well. What are you going to do with it? And what's sort of your end goal here?
Well, you know, I think if you look at, first of all, Salesforce to this day is still, they still are the greatest innovator in cloud-based corporate tools. And I've known Mark Benioff a long time, even though I never told him that we were doing this with his own team until it was done, because I didn't want to, I didn't want it to come from the top down. The Salesforce team is really phenomenal. But, our fantasy was to work with Salesforce because really nobody understands the business of cloud-based corporate tools better than they do. And I also like their ethos as a company. I think they have a great customer service ethos there. But, if you look at, think about today, would you ever get a FedEx package with signature tabs on your legal documents? No, you get it in DocuSign now, right? You don't manage your cap table in Excel spreadsheets anymore. You use Carta. And we've made this evolution toward lots of aspects of corporate function have gone into the cloud, but this really critical function hasn't. And we think that on a business level, to be honest, if you look at Carta, which is a $7 billion private company, and DocuSign is a $15 billion public company, there's an enormous market in relatively low-priced corporate software tools. And we really thought this was a good business. We think there's a very large marketplace of companies and nonprofit orgs that need to reform this critical piece.
Our thanks to Zeck co-founder Edward Norton.